welcome back. We start off this segment with a big voice for the commodities space. Viktor Shvets, the head of commodities at Macquarie, believes one should invest in armament manufacturers and security firms. Speaking to Bloomberg News, Shvets says it's too volatile to bet on commodities right now. Listen in.
It's a tough one. I think the best thing to do is to buy weapon manufacturers and to buy security firms and to buy surveillance firms, because what's happening is that people can't agree. It's not that Donald Trump necessarily wants to be extreme or Iranians wants to be extreme. Neither Iranians nor American people agree on what needs to happen. Neither the British. I mean, if you think about it, more than 50% of Brits voted for Labour Party or Scottish Nationals or Liberal Democrat. That means they didn't vote for Brexit at all. The same applies to India. So when you're in a position where pretty much people everywhere cannot agree what is the right path forward, politics cannot find the right answers. If politics cannot find the right answer, buying weapon manufacturers and security firms and surveillance firms is actually the right investment strategy. Whether Iran has already responded, I think it's doubtful, but nevertheless, I think it's not as relevant. If it's not going to be Iran, it's going to be something else coming down the pike.
But, I mean, there are different types of geopolitical events, right? There's one, I mean, there are the types where every week you'll have something, the world doesn't get along, and then you arguably have something like this. How would you describe this? Is this different? Does this have... Okay.
It is. It's a step up, primarily because it's a geopolitical mistake. And so whenever you make those geopolitical mistakes, there is a step up. But once again, people tend to forget how potentially volatile and explosive Brexit could have been to financial markets or otherwise. People tend to forget how explosive Hong Kong can be as well. So yes, it is a step up, but all I'm saying is that similar steps and downs will go on. And how much one should reflect it in equity markets is a big question mark.
Right.
My view is simple. Central banks are flooding the system with liquidity. So long as that is the case, equity investors are quite willing to expect that central banks will fix economic problems and politics will fix geopolitical problems. And that is why equity markets remain quite placid. As soon as central banks stop supporting the market, that's when the volatility is going to come through.
Well, Viktor Shvets believes buy armament manufacturers. Let's ask Andrew Holland if he believes that as well, because he looks at not just India, but has experience of looking around the globe as well. The question is, what does he believe Indian investors could do in the current time? Andrew, good having you. Thanks much for taking the time out. The Macquarie Global Head of Commodities and Alternate Strategies believe go out and buy armament manufacturers because this may not be the end of it. Is it as dire? I'm sure it was a tongue-in-cheek comment, but I'm just saying, is it as dire, or would you believe that the markets will kind of digest this piece of development that has happened overnight?
Yeah, well, I think the market's reading two things. One is that, Iran has said, this is, our kind of retaliation. We're kind of done. If the US is done, we're not going to do any more. So I think the hope now is that, tensions ease and President Trump doesn't take the next step. What the next step is what? To escalate everything. So that would be obviously something the market's not factoring in. But let's just take the worst, a little bit more of the worst case situation that oil prices spiked, say, towards 80. Now that hurts the world economy, not just India. Anyway, growth is pretty fragile. But if you think about higher oil prices, which will mean obviously higher inflation, which will mean that input costs will go up, and therefore the consumer will obviously start to stop spending as much, which means that's the last leg for the US in terms of the consumers really held the growth there. So I think President Trump's thinking about the economy, and he wants to always project a strong economy and a strong market. Then maybe he won't take the next step, and then we go back to the scenario of oil prices falling because really demand is not there at this present time. And growth will slowly pick up globally, and that will be good for emerging markets. So that's the kind of base case. He said he's going to take action or make a statement tomorrow morning, so tonight our time. Let's see what that is. But the markets at the moment have recovered, and hopefully there's not been too much damage in Iraq in terms of the army base. Therefore, the retaliation will be less severe. Maybe it's just more of a war of words now.
His tweet seems to suggest that, and even the tweet from Javad Zarif of Iran seems to suggest that they do not want a warlike situation. It was a bit of a tweet which probably indicated that we've taken this reaction because we had to, but now we do not want to move ahead. At least that's what the wording seemed to suggest. And in which case, Andrew, one, how do you see the global market shaping up? You mentioned that crude might resume its downward journey because there's not enough demand. What does all of that do to the world markets, which are anyways trading at fairly high valuations, and therefore to the outlook on India? Because everybody was concerned that what happens if crude moves up to 75, then we have an issue. That may not eventually turn out to be the case.
Yeah, so if that's not the case, then we go back to what I said, there's a base case, which is that global growth starts to pick up, led by the US, then Europe, UK, and China as well, stabilizing. We've seen some green shoots there. And that would mean that, investors will be saying that interest rates will stay lower for longer, which is obviously what the central banks will probably try and accommodate as growth picks up. That will be good then for exporting countries, as global growth picks up. And then, therefore, emerging markets will probably receive a lot more funds flow, and India being a large weightage in emerging markets, we would get our flows. Maybe not the kind of 9% weightage that we have, but we would get flows. So that would be the good news. And then obviously everyone will turn their eyes to, in the very short term, to the budget in India. But from what we're seeing from our lens is that there's some kind of recovery coming through in the economy here. But obviously, if oil prices were to move a lot higher from here, then everything's off the table, not just for India, but for globally as well. So obviously, we're hoping that the leaders, President Trump, just doesn't take things further forward at the moment.
Andrew, for India in particular, obviously we already spoke about the negative impact on the balance of payments for India because of crude oil prices moving up sharply. But, aside from that, from an equity market standpoint, even earnings this time around are not expected to be a game changer of sorts. And also the fact that we've seen so far that the equity markets have been driven only by a handful of stocks. So likely, while we've recovered from the lows of the day, do you feel that we are still more prone to larger whiplashes with news that comes in from across the globe and our own earnings not picking up?
So I think, for India, it's going to be, I think we're going to still see the same as last year because, the large companies are continuing, in each of their sectors, are continuing to take market share. Because the economy is running at around 5% GDP growth, the small and mid-cap companies are obviously suffering in terms of operational gearing, in terms of cash flow. So they're not in a position to kind of fight their way through this slowdown as a maneuver as quickly as the large companies. So I think we're going to have this divergence for a little bit longer, maybe another quarter or two, before you start to see signs of the economy recovering. And of course, what will happen is that the large caps will be more operationally geared to that initially, and then you can look at the small and mid caps, which will obviously then start to benefit from the economy recovering. But we're 6 months away from that, and I think that's why you're still going to get this divergence in terms of the markets. And also, if you think about the funds flow coming into India, if it's more passive, then it's going to just replicate an index. So the weightages of those 10 to 12 stocks have got higher in the past 1 year. So you're going to get more incremental money into those stocks, which causes the same kind of problems as we saw last year in terms of a small handful of stocks moving the market.
And just a few weeks back, we'd actually seen, a closing in of the gap between the mid caps and the large caps. So while we've been talking about polarization all this while, there were some signs of a recovery from the mid cap space as well. Does all that go out the window now? And you were back to conversations, like you just said, of sticking to large caps?
Yeah, I think, listen, you can dip down if you like, and obviously there's some quality companies in the mid and small caps, where the management's strong, they're in a good position in terms of their markets and the products they have. But it's very selective in that. So I'm taking a broader view now in terms of small and mid caps. It's still going to be a tough 6 months ahead. For them until the economy really sees signs of recovery. So you can take that view now, but you're really banking that the economic growth rebound is going to be quick and sharp, which I don't think it will be. It's going to be more of a U-shaped recovery than a V-shaped recovery.
Yeah, certainly so. Andrew, so if indeed that is the case, are there timelines that you're working with? Because a lot of people are working with timelines as to when the growth will come back, even though it's very difficult to estimate that. My question really is that this U-shaped recovery, can it gain prominence once the second quarter or the third quarter of the next financial year goes by? Is there a way to try and predict that? Would you make bets like that?
So I think what I'd be looking for is within the large companies, will give you a good indication of whether growth is picking up. Yeah, you can say that they're taking market share, but it will also show through in their margins, and operational gearing will start to play in. So I would say that would be the consumption side of the story. So there'll be the large cap companies which will show the first kind of signs, and therefore if you're thinking about that, and let's just take the auto sector, let's say Maruti and all of the big companies start to kind of do well, then you can start maybe looking at the kind of ancillary players, the parts suppliers, which are mainly kind of small and mid cap companies that would then start to see the benefits of that. So it's going to be the large cap first, and then it's going to be the mid cap. So I think you're probably 1 quarter away from seeing that in the large caps, but for the real evidence, you probably have to wait 6 months before you kind of, with confidence, would buy into mid and small caps. So I think those are the kind of timelines we're working on. Let's get the budget out of the way. So by maybe May, June, we'd be in that position to kind of think about mid and small caps on a kind of as an investment destination away from the kind of 10 to 12 stocks which have moved the market.
Okay, so wait for large caps to do their magic, maybe 2 quarters, 3 quarters in a row, which might point towards the sign of recovery. Andrew, the other small question though, since we're talking about, since we mentioned let their budget get out of the way, the numbers that got announced, the advanced estimates of the GDP, and the fact that growth is recognized to be slow, and at those current numbers, the fisc deficit numbers would arguably be closer to the 3.5%, and maybe may even see a number below, even though this government is steadfast on making sure that the fiscal discipline stays put. Should the market in its wisdom believe that there is slippage, is that a risk post-budget for the Indian equity markets?
Well, listen, we want it all ways, right? We want to see the government kind of spend its way out, for example, and kickstart the economy, but without the kind of problems initially on the fiscal side. Now, if you kickstart the economy and your fiscal goes a little higher in the shorter term, that's okay as long as the economy rebounds. But if you do nothing, then your fiscal still remains bad, and you're getting no growth. So whichever way I look at it, we can't have our cake and eat it this time around. So I think I would rather see the government spend some money, maybe kickstarting some of the projects which are stuck, or getting the power sector moving. So it really gets the whole cash flow, throughout the system, helping projects come to fruition, not just in kind of just infra projects, but real estate as well. And that I think will give you that fillip. And therefore, if the fiscal kind of just kind of goes up a little bit in the short term, I'm kind of less worried about that, and I think investors would be less worried. We're not alone in this. All the global economies now looking, and central banks are asking the governments to start looking at fiscal expenditure to help propel the economy from where we are, because negative interest rates isn't going to grow your economy, that's for sure. It's going to help ease the burden, but it's not going to get you growth. So what India, I believe, we need to do is get the fiscal spending kind of underway, which will then help the economy. Yes, interest rates might kind of hold steady rather than go down from here. But obviously the RBI, we're seeing the kind of operations it's doing is keeping liquidity very ample, so the system is not suffering from higher yields at the moment.
Okay. Just want to get your sense on what happens now, whether or not, while obviously the government is doing what it's doing, private sector capex can pick up or not. Do you feel that could be something that one needs to keep a close eye out on, how this period of lull is the most opportune time to make some of those investments, preparing ahead of time for the growth that could eventually come in?
So I think the private capex cycle keeps being pushed out, and it's all about confidence, right? And if we're talking about GDP of 5%, then obviously corporate India is going to think I can wait before I start to start any investment in new plant and machinery. So it really be the government will have to lead this for the economy to start to recover before you see that private capex cycle coming in. But the other thing is that, with the tax rates, the corporate tax rates for new investments, it is compelling. So if Indian companies don't do it, then I do feel that if the regime in terms of the tax kind of stability is there for foreign companies to come in, land and labour reforms are there which will help them come in, then I think it'll be the foreign companies which will take advantage of this lower corporate tax rate and the pickup in Indian growth. Because it's just this is a 1 year in the next decade where you still expect consumption growth to be a leader for India. So there's going to be plenty of opportunities. So I'm trying to look at the very short term, which is, yes, private capex might not pick up in the next 6 months, but it should do in the back end of the 6 months if the economy recovers as we expect it would be from here.
Okay, Andrew, the one small question though, I know you mentioned that oil is likely headed lower, and if that happens, it's all okay. But I heard you mention in your answer that if for whatever reason oil doesn't, then that puts paid any kind of theories that people have right now. What if oil does nothing? What if, because of the uncertainty or otherwise, oil stays at the 70 levels? As one, as the economy, and two, as companies which are also consumers of oil, is $70 to the barrel mark a negative or a workable option to your mind? So, we've been running around this level of between 65 and 70 anyway for the past year. So it's I think most economies are used to it. It's really if it spikes to 80 or more where I think the global economy will have a big problem, including India. But my view is, unless you're expecting the Middle East to keep bubbling in terms of tensions for the next 12 months, which will keep oil prices at 70, which I doubt, then the global demand right at this moment for oil is more towards that kind of 60 to 65 level, not 65 to 70 level. So that's what we're working on in terms of our assumptions. So, but it really now depends in the very short term of what Trump says, President Trump says tomorrow morning or tonight our time, and if there's any further escalation. But the oil price, if you think about the Aramco kind of oil field when it was hit by those bombs, I think the price went up to 75. We haven't seen that this time around, despite the kind of direct intervention by the US. So it's telling me that demand isn't there, and maybe this is a one-off event and will not continue for a long period. And anyway, Iran and Iraq, in terms of oil production, is not that huge anyway. So it's at the margin, and I'm sure, any Saudi and the US can pump in more oil if need be to keep the markets supplied. So I really don't see why the oil price should remain at 70 if there's no further escalation.
All right, Andrew, just talk about the trends or what you're liking. I know last time we spoke, you said you like the non-lending NBFCs, you like insurance, you like AMCs. Is that a theme that you will pursue? Andrew, can you hear me? Hi, Andrew, can you hear me? All right, yeah, I think
we missed that line. Well, yeah, I think the sum and substance of this Andrew Holland conversation, and we'll just try and get in maybe one more voice before we wrap up the show, but the sum and substance of this conversation seems to be that bet on the large caps right now, because if the large caps show that operational recovery, then you might actually see the mid caps. He is seemingly of the opinion, as a lot of people are, that this will not escalate into something too dramatic, and will not really escalate the prices of oil as well. His last answer seemed to suggest that Iran,
65.
Yeah, I mean 65 to 70 or thereabouts at best, and maybe crude is on its way down. So the key concern for the markets, Andrew Holland at least, is of the opinion, it may not be, but it might be all bets off if the Donald Trump statement tonight, our time, and morning US time
Signals
is slightly different than what the markets might be working at right now. They're taking his last tweet as the indication of what could happen. If something changes, then that might be a negative.
Which means that you're sitting on the edge right now with regards to markets. And from a trading standpoint, and from a trader standpoint, it's an extremely difficult bet to gauge which side this could swing. And therefore, it's a very risky proposition at this time to take any big bets in the market.
It is, but the market seems to be taking some bets because we are now just about 0.36% lower. It might. Okay, and of course, it pays, Devina, to get in more market opinion as well, more so very important global opinion.
Yes, so we've got with us Mark Mobius. He's joining us right now on the phone line. A very important day, to get you on the phone. Mark, thanks very much for joining in. What have you made? What has been your assessment of what has been happening? I mean, the day before yesterday, you saw the big collapse in equity markets, the initial knee-jerk reaction to what Donald Trump did, and then a retaliation from Iran. So we did see that escalation taking place. Do you see this worsening?
Well, I think the Iranians, of course, have no choice. They must retaliate. Otherwise, they will be seen as too weak in the eyes of their own people. In addition, I believe that they still believe that by threats they are able to cower the Western powers, particularly Europe.
All right.
Mark, can you hear us?
Hello?
Yeah, Mark, please finish your point. We just lost you. Please finish your point.
Yeah, I think the Iranians believe that they could cower the rest of the world by additional threats, and that policy that they've followed up to now will not change, I don't believe. So therefore, we can expect further turmoil globally. But you must remember that investors generally are taking this in stride because this is not new. You know, we've had the situation going on for quite some time now. So I believe that after the initial shock, then people will begin to quiet down and begin to realize that it's more of the same. However, the big question mark, of course, is oil prices. As you know, oil has already surpassed the $70 level. And if it goes higher, then, of course, countries like India, who are importers of oil, will be affected. So this is something we must consider. I don't think the effect will be dramatic, but let's say if it goes up to $80 a barrel, then, the consequences will be felt.
Okay. What do you think happens to equity markets, Mark? And do you feel that investors will rather take a backseat because of the overhang of what comes about with regards to the U.S.-Iran tensions? Do you feel allocations will be held back?
I think equity markets will continue to perform well for a number of reasons. One, interest rates continue to be very low, and in many cases going lower. That's number one. Number two, infrastructure spending throughout the emerging markets world is growing at a fast pace. We're seeing that in India. We've seen that in China. We've seen it in Sri Lanka. I'm now in Indonesia. I'm seeing an incredible amount of infrastructure spending. So that is going to also boost these economies because governments are now, with these low interest rates, are able to raise funds to do this kind of construction. The third point is that we must remember that emerging markets still are growing at double the rate of the developed countries, so the prospects will be very good for this year. And finally, the U.S. economy is doing well, and when the U.S. is doing well, the rest of the world tends to be affected favorably. So I think that's a very, very important point to remember.
You know, foreign investors look at emerging markets, and particularly markets like India for growth, but that seems to be elusive now as well. Recent, advanced GDP numbers for FY20 coming in at 5%. Now, is that a growth number that's attractive enough, Mark, for investors to come and put money into a country like India?
Definitely. I mean, 5% is incredible growth for a country the size of India. So I wouldn't consider that to be a low growth rate. Of course, we've seen much higher in the recent past, but I believe India will recover to a higher rate. But 5% is certainly nothing to sneeze about, and I think it's very, very good growth.
You consider increasing allocations to India, or there are better markets for you?
No, I think India is really the focus. We're really very interested in increasing our allocation to India. It's already high. It's second, slightly lower than our allocation in China, but still it's very high.
Okay. Coming to the budget, we've got the budget session on the 1st of February. Anything big that you're expecting from the government, and anything that you feel should be addressed and that will be a positive reading from a foreign investor standpoint if it does come about?
I think the government really now has to start focusing on efficiency in government. When Modi came in, we all felt that he was going to be cutting through a lot of the red tape and making it easier for business people. And more recently, we found that this is not really taking place at the pace that we expected. We'd like to see more done in that sense. For example, nowadays, people tell me that in order to do something, you need 5 or 6 identity cards to get things done. And they've got to simplify this whole process. Very important.
All right, got that. Mark, thanks very much for joining us. Really appreciate you taking out the time this morning and speaking to us on BloombergQuint.
Thank you.
Thank you. That's Mark Mobius there. So equity markets will continue to draw the kind of attention that it has been. So he's not worried from the equity market standpoint. And 5% growth, he's pretty okay with that for India.
Yeah, I think I've heard a couple of other people say that too. But let's see, for now, the focus is not necessarily only on the here and now, but more on what Donald Trump says.
What lies ahead.
Yeah, but in light of that, we've not done too badly for ourselves. Let's see how the day shapes up. It's a wrap on this leg of Indian Open with all the market opinion that you possibly needed from Devina and me and the team that put this show together. Thanks so much for watching. The F&O show takes forward the action on the other side. Stay tuned to BQ Live.